So now we're looking at what kind of loans do we actually want to access? What's available to us out there? So we think about it, of course, we want to focus on inexpensive loans. Would include from parents or family members. That's that direct lending that we talked about before. Loans that use financial assets, something where you have collateral. So those are the least expensive loans where you've got something to kind of back it up, or you've got a friendly resource that would be available to this. Next would be the medium price loans. That would be at like through their financial systems, commercial banks, savings loan associations, depositories, credit unions. And then there are expensive loans that would be through, again, check cashing companies, retailers such as used car dealers, appliance dealers, et cetera, bank credit cards, and cash advances, and tax refund loans, payday loans, et cetera, all the things that you would associate with that. So there are various laws that have been put in place at the federal level. It's the Truth in Lending Law, where you have to disclose the APR, the annual percentage rate, and that is the not just the stated rate of interest, but also includes any kind of interest costs, service charges, credit-related insurance premiums, or any kind of appraisal fees. So that's how we arrive at that APR. It's like the fully loaded interest rate, if you will. So again, this is the one you want to look at when you're comparing costs. So the APR is that true rate of interest, so you can compare those rates, between other sources of credit. So again, the law does not set interest rates or other credit charges, but it does require disclosure so you can compare the costs. There are interest rate, depending upon the state, there are interest rates that are, maximum rates that can be charged, et cetera, usury rates, as they say. But the point again is the APR is the key. You're able to determine what the costs are, what your total cost, your total monthly payment, for example, is going to be. So remember, the interest rate is a price. It's a price that you're paying to access that credit. How much the lender is willing to loan you at what rates, what are the terms that are. So some ways of reducing the lender's risk, if you will, on their side is to accept like a variable interest rate, which is typical when we talk about credit cards and also like mortgages. There's a variable rate mortgage, the adjustable rate mortgage arms. Providing collateral to secure the loan, so something to back that up, making large cash payments, down payments up front, accepting shorter term loans, which again, remember, time value of money, the longer you're away from your money, the higher the interest rate is you're going to be receiving, and also that you're expected to pay on the other side of this. So again, calculating that cost of credit is pretty straightforward, simple interest, a lot of different ways of doing it, but interest is equal to principal times the rate of interest times the time that's associated. So again, interest equals principal times rate times the time that's associated with that loan. So if we're talking about declining balances, so keep in mind that just as it works with composite interest, it's the same way when we're talking about declining balances, meaning that as you're paying off the principal on the loan, then your interest payments, the amount that you're actually paying in interest will begin to drop, will begin to fall. So that's why as you're repaying a loan over a period of time, the longer you're going about paying off that loan, the more interest is going to be reduced that's associated with that outstanding balance or that declining balance. So the more frequent your payments, the lower the interest you will pay overall. Again, using that same simple formula that we made. So again, anyway, the cost of open-ended credit. This is again on the amount that your previous balance, your adjusted rate balance, adjusted balance method. The point again being is that the more you're using your credit card and the higher the balances go, the greater the interest that you're going to be paying for that. And again, the interest is typically either on a daily or a monthly basis. So it could be on a daily basis, could be on a monthly basis, dividing the year up into 365 days or 12 months. And so you're paying the interest on that previous balance, and then the more you're adding to that, the following month that's going to be added to that, as you, if you will, is going forward. So again, the cost of open-ended credit can get kind of tricky and can get very, very costly if you continue to pile on, add more debt to your, increase your expenditures and adding more to your debt as you go. So this average daily balance method. This is the one you want to target if you have a credit card. It's pretty straightforward. It's the fairest method of computing finance charges. Creditors add your balances for each day in the billing period, then divide this by the total number of days in that billing period. Then multiply this average balance by the monthly interest rate. Again, new purchases during the billing period may be included or excluded from the average daily balance calculation, depending upon the grace period that's involved. So beyond that would be like the 2-cycle average daily balance method may include or exclude new purchases. The method of computing finance charges uses the average daily balance for 2 consecutive billing periods. This has been banned so far as the Credit Card Act of 2009. Again, grace period. The creditors must tell you when the finance charges begin on the purchases that you make, because typically there is, or there should be, a grace period involved when you purchase something. The cost of credit and the expected inflation. Borrowers and lenders are concerned about goods and services that the borrowers can buy. Inflation, again, erodes the purchasing power of that money. So this is, again, where credit card companies, they often have variable rate, interest rate charges, if you will. So if inflation goes up, that rate of that interest rate would go up accordingly. All right. So cost of credit and tax considerations. Interest paid on consumer credit is not tax deductible. This is as opposed to when we talked before about the home equity line of credit. That is tax deductible, and if you itemize your expenses, itemize your deductions on your income taxes, it makes sense to kind of go that way rather perhaps than going out there and accessing consumer credit, because again, that's not tax deductible, as opposed to commercial endeavors when they do use credit, that the interest that they pay is an expense. It's an expense item, reducing their income regardless. Avoid that minimum monthly payment trap, because what happens is that if you just pay the minimum amount, it could take you years, and you would be paying back multiple times the amount that you actually borrowed initially. So this is a very scary example, but you purchase a $2,000 sound system using a credit card with 90% interest, 2% minimum payment. If you pay just the minimum amount, it will take you 265 months or 22 years to pay off the debt and cost you nearly $4,800 in interest payments, in addition to that $2,000 that you've paid. So early repayment and credit insurance. Early repayment rule of 78 favors lenders. Formula requires that you pay more interest at the beginning of the loan. When you have to use the loan, use more of the money and pay less and less interest as the debt is reduced. This is, again, the rule of 78, again, favoring lenders in the process. So this is, again, a plus for lenders, which encourages them to do what? To lend money, really, is what it comes down to. Credit insurance is something that honestly you want to avoid, and that ensures that your loan is paid off in the event of death, disability, or loss of property. 3 types of credit: life, credit, accident, and health, and credit property. Premiums, again, are very, very high, and it's typically just not worthwhile to doing that. So the Credit Card Act of 2009 limits the increases in APR in the first year, again, because they are variable. They can charge higher rates, if you will. Restricts issuers from charging higher interest rates on existing balances. So if you have an outstanding balance, you're paying that original interest that you had set up, and it adjusts accordingly. Teaser rates must be effective for at least 6 months. So yes, you get a 0% interest, but after 6 months, it's going to go up to 19%. And these are what we mean by teaser rates. Issuers must mail statements at least 21 days before payment, so giving you adequate time. So these are the ground rules that are laid out that have really improved the credit card process in particular for consumer credit, in that the borrowers, in this case you and I, if we're borrowing, it makes this makes our life much easier in terms of being able to schedule things and knowing what we're looking at, understanding the rules of the road, so to speak.